You noted that under the surface, that there has been a frothy market conditions that have been building, and there are many ticking time bombs among private companies. Please explain.
Well, a lot of attention is paid to the IPO market and the companies that are really emerging above the surface, if you take the iceberg metaphor. But underneath the surface is a giant market that has had a tremendous influx of capital over the last 10 years in private equity, alternative lenders, a whole variety of members of that asset class now looking at both equity and credit provision to private companies. Because there's been so much, there's been really a chase down the credit curve for yield by those investors, which means more and more capital has been going to weaker and weaker companies that in a more normalized market wouldn't have had access to that much capital.
Do you think that the overvaluation is more prevalent and more extreme in private markets right now than public markets?
Well, I think there's enough to go around, but there's a lot of overvaluation in the private markets, particularly in the segment of it that is really driven by the venture capital community. Because the venture stage companies are funding round after round after round, always looking for higher valuations. When those that are coming into the IPO market are emerging, they tend to have such high and lofty valuations that it's right now we're seeing the public market choke on that.
Do you think that private tech companies are some of the most egregiously highly valued right now?
Well, they are. I mean, there are others, of course. There's a lot in biotech that's highly valued as well. But the tech companies, for certain, you look at the WeWorks, you look at the Pelotons, even some of the ones that came earlier in the year, certainly Uber and Lyft. These had very, very high valuations. And WeWork pulling its deal and the others not performing well are a really good example of how the market reacted.
And there's a lot behind that, you're saying. There's a whole iceberg behind that.
Right. When you go further down, the companies that you don't see as often are the ones that are the 10 to 50 to $100 million revenue companies that are not likely to IPO at any time. And they're being funded by alternative lenders, by banks, community banks, regional banks, sometimes the large banks. And that is a giant market area. And we rate a lot of those companies for our clients who are particularly worried about those companies as members of their supply chain, because upstream they are needing to support them with all sorts of services.
So which companies look like they are fairly or maybe even undervalued within the private markets?
Well, it's very case by case, and I wouldn't look at it from an industry perspective. I'd look at it case by case within industries.
But these are the industries. You did cite some that on average have better than others.
The ones that have really been doing well recently in the last couple of years are forest products, are some of the oil and gas midstream providers, the drillers, the home builders. These are private companies that are under-levered relative to their public peers. They have larger, they've got more efficient asset bases. They're not holding great deals of property like the public home builders are in that sector. And so compared to their public peers, they tend to be between 5 and 10 points on our 100-point scale better rated than their publics.